to talk a little about money, not too surprisingly. Now, I'm going to be honest with you, I'm going to actually talk a little bit about currencies, although it's not by any means my chosen specialist subject. Anybody who's had the misfortune of hearing me early in the morning on Radio 5 or Radio 4 will recognise that as soon as I get a question about currencies, where's sterling going, what's the dollar going to do, I say, you really don't want my views on those because I'm even worse at currencies than I am at oil, and I then try and move swiftly on. But we are going to talk a little bit about currencies because they are, along with government bond yields, perhaps the most visceral and visible way in which financial markets express their faith, or lack of it, in a country's political system and its economic system, its economic outlook. So they are very, very quick measures of looking at what the markets are thinking about a particular option or asset class. Another disclaimer. For those of you who remember Monty Python, this is their version of the money program from 1973. As Eric Idle sang, "Who doesn't hanker for the butchness of the banker? It's accountancy, not love, that makes the world go around." And he then sings this bizarre song with, I think, people in either Dutch or Welsh national dress in front of him, talking about the lure of the lira, the romance of the ruble, and the antiseptic sting of the Swiss franc. Anyway, we will be talking about currencies, but probably not those ones necessarily. So this is the running order. The current consensus, what it's telling us, very important to know. Central banks, what they're up to, how that's shaping money flows, and then just a little look at where we may be in the current market cycle and what might be of more interest and what might be of less interest. This is not for me, this is not me being cheeky. This is just to show how hard it is of somebody who's been on the sell side as an investment analyst. You unwittingly form part of the consensus, whether you like it or not. And you go up and you forge your honest, well-intended, well-researched opinions and find out, oh God, I'm saying the same as everybody else. Well, that's not much use, is it? Because by the time you're saying the same as everybody else, it's probably kind of in the price. So the irony here, of course, is 2021, we were all being told that inflation would be transitory. Not correct. In 2022, we were being told that we were a recession coming with interest rate cuts and a cooling in inflation. We're still waiting for that recession. Even though we had a very mild one here in the UK, we certainly didn't get one in America. In 2023, we were promised a soft landing, a cooler inflation, and rate cuts. No, still no rate cuts, still no recession, still no real landing as such. And now, well, we're being peddled the same stuff, and we're still waiting for the first rate cut from the Bank of England and from the Fed. We were promised 6 by the markets. We now may get 2, with the first ones possibly coming August, September, rather than March. So just be careful. Following that consensus can get you into a little bit of trouble. Though having said that, it's not done an awful lot of harm. Equities overall have done pretty well because there have still been some positive headwinds. Inflation is indeed less aggressive than it was. It's still running hotter than policymakers would like, perhaps, but it is nevertheless the rate of advance is cooling. Whether that's down to a base effect, energy price caps, energy bills, or something more fundamental and sustainable, we will find out. But for the moment, at least, that is giving markets some confidence that we will get those rate cuts, we will get cheaper money and some more plain money to come. America is providing plenty of fiscal stimulus. The Biden administration is spending like a drunken sailor as it goes into the November presidential election. They've cancelled $130 billion of student debt. Wage growth is pretty good. And if you really want a feel for how much money the Biden administration is pouring in, it looks as if in the 4 years of Biden's first term, we'll find out, the US deficit's going to go up by about $7 trillion. It took America until 2003 to borrow $7 trillion in its entire history, and he's done it in 4 years flat. Even allowing for inflation, that's pretty good going, and not surprisingly, you are getting some support for the US economy as a result. The absence of a stiff recession, corporate earnings have generally held up okay, dividends and buyback activity has been strong, helped by lower energy bills, and then the hopes for interest rate cuts. So there have been some things that have been helping. This, of course, is then kind of quantifying the change in mood as far as interest rates are concerned. 367 rate increases in 2022, just 16 cuts. We've already had 50 or 60 cuts this year and just 15 or 16 increases. And the increases are generally company that you don't want to be keeping because there are economic problems there. So we are indeed, it does feel as if we are through peak rates, even allowing for the fact that inflation is sticky. And the Atlanta Fed even has now got its own sticky inflation index because 70% of the American CPI basket doesn't change every month. Season tickets, healthcare, insurance, school fees, university, college tuition fees. So they're tracking that, and that's still running at 4.5%. So inflation is proving quite sticky. But even then, markets, central bankers are certainly not discouraging thoughts of interest rate cuts, even though inflation is still a little bit hotter than they would like. Maybe we have indeed had that pivot. So what does all this mean? Well, this is the bit I'm best at because it's telling you what's happened, and even I can't get this wrong so long as I can read the chart properly. So the bars are what's happened in the last year in capital terms, in local currencies, and the red line is the same over 5 years. I'm not going to talk about Bitcoin at all unless you lead us into that one in the Q&A. It has done well. I guess the rationale for that is only 21 million units in circulation, whereas central bankers have conjured multiple tokens out of the air. And this is when we're going to get into the real crux of the money discussion in a minute. In the Economics 101, I was always taught if the supply of something goes up, then its value goes down. Well, look how much money supply has grown in the last 5 or 6 years. QED, money is worth less. Maybe that's why we've got inflation. And Bitcoin, maybe some people are viewing that as a hedge against that, as indeed they are gold, which is now setting a new all-time high. And commodities are now on a 5-year view, starting to give equities a bit of a run for their money, depending on which benchmark you use. And the ones that have found it perhaps the hardest going over the last 1 year and 5 years, and Reese will talk to you with much greater authority than I about this, has clearly been fixed income, where this era of zero interest rates, certainly at least temporarily, has come to an end. And in terms of indices, well, Japan has actually been the best performer over the last 1 and 5 years. In local currency terms, again, I stress. In sterling terms, you've lost about 3/4 of your gains to the yen going through the floorboards, and we'll come back to that in a second. We know that the NAS has done well, India's done well. The poor UK down over on the right-hand side is at least showing some more wiggle now, and we'll talk about that later. And then the tail-end Charlies have been China and Hong Kong. America, we've talked about it a lot. So the Fed, last autumn, Jay Powell talked, I thought, pretty loosely about, we're through the worst in terms of rate hikes, and he's certainly done nothing to discourage talk of interest rate cuts ever since. But there are things that they have to think about. That there are reasons why they might want to cut, but there are reasons why they might want to do nothing either, because inflation is sticky, wage growth is strong. Low unemployment is below 4%, and you've got the Biden administration shoveling on all of this stimulus. They might want to cut because job vacancies are falling, and the American interest bill is $1 trillion a year now, ladies and gentlemen, on that $33 trillion deficit that they've got, to which friend Biden is adding quite quickly. That means now they're starting to spend more money servicing their debt as a percentage of GDP than they are on defence. And as the historian Niall Ferguson always tells you, any country that spends more on servicing its debt than it does on defence doesn't stick around as a great power for very long. That's why the Soviet Union collapsed. And then they've got to think about financial stability, a year on after 3 bank failures, and they have the election. The Fed did not enjoy being kicked around by Donald Trump. I'm sure it wouldn't like it again either, but equally they've got to be seen to be as impartial as it can possibly be in the run-up to election, so we shall see. And if Trump gets in, he doesn't strike me as being a disinflationary force. He's pretty good at spending other people's money, he's pretty good at borrowing other people's money. He didn't do much to cut the deficit when he was in last time, though much of that, again, will depend upon what happens with in Capitol Hill and whether he can actually get anything done or not. So this is the tricky bit the Fed's got, because signs are that inflation, even knowing for the CPI print that cooled last month, PPI, factory gate prices, and the Fed's own preferred measure are showing some signs of increase, and again, that's because that sticky underlying inflation, so that will still be exercising them, and that's why they've not yet cut rates, so you don't want to see that creep up much more. And this is the debt situation. So that's the annual budget deficit, and then the aggregate deficit is the red line, surging to new all-time highs, and that is now costing America $1 trillion a year, which is a good reason for America to want to start cutting interest rates and, frankly, tolerate a bit of inflation, because it'll inflate the debt away. Money supply. This is perhaps the most compelling argument, in my opinion, for why the Fed might actually start to cut rates and be justified in doing so. Again, to go back to pure monetary policy, if we were talking about Margaret Thatcher and Alan Walters when they were in charge 40, 50 years ago, all they talked about was money supply when they were thinking about interest rates. They weren't thinking about jobs, they weren't thinking about inflation, they were thinking about one thing only, and it was this. And again, just look at how US money supply grew during the pandemic. We can argue whether it was the right or wrong thing to do or not. Don't know, mate. But they certainly pumped it up. Now, money supply growth has been negative for most of the year. And if you think that it's a central bank's job to set policy for 2 years hence, because that's how long the lag is for monetary policy to take effect, maybe the Fed is justified in thinking of rate cuts. And it's the same picture, by the way, in the UK. Money supply growth right now is flat to broadly negative. That perhaps does speak of the need for cuts, even if the central banks are saying we're data dependent, And of course, by being data dependent, they're driving the car looking in the rear view mirror because the data by definition is backward looking. So the danger of policy error remains. The market is pricing it, the equity market is pricing in this very benign Goldilocks scenario, but you still have policy error risk of cut too soon, too much inflation, cut too late, end up with a recession or disinflation of and a squeeze on. So at the moment, the equities are pricing in a benign scenario. There are other markets that are not. I mean, this is the interesting thing on US CPI inflation against money supply. In the end, it does work. I mean, you can track with about an 18-month lag. Inflation does seem to kind of go where money supply growth has been. So I know it's no longer in fashion to talk about it, but it does seem to work as a method. And one interesting thing on watching money flows, this is US money market fund holdings, $6 trillion sat around doing not very much, apart from gathering 5 and a bit percent. If the Fed does start cutting rates, I'd love to know where that money's going to go, because it's going to be an absolute tsunami. Whether it's equities or bonds, I don't know, maybe a combination thereof, or something else, depending on what the inflationary scenario is. But that's definitely a money flow stat to watch, and that would lead you to think of maybe a melt-up type scenario. Now, lots of choices. We've all spent lots of money, whether it's on fighting COVID or even the great financial crisis or the European debt crisis or whatever it happens to have been, but there is no such thing as free money. There has to be somebody paying the ferryman at some stage. And you've lots and lots of different ways of paying that. You can pay it through higher tax. Good luck to any politician trying to get that one through in election year, or indeed any other year, forget it. So then you're looking at inflation, because you printed more money, so it's probably worth less, maybe higher interest rates, or indeed a falling currency. And maybe that's one of the reasons why perhaps Bitcoin is having a bit of a run, or even gold, even though it yields nothing, is intrinsically difficult to value other than its incremental production cost, is having a run as well. And currency, so that's against the dollar. So the dollar is losing a lot of value relative to inert, useless bits of metal that are very hard to get out of the ground, which again may tell you something what the market's thinking, that perhaps the Fed isn't entirely in control. And our good friends, the Japanese, well, they've made their choice. They're just laying out the currency to rest. They keep on printing money. They've got interest rates at 0.1%. That's the choice that they've made to try and conjure themselves out of years and years and years of deflation or disinflation. So that's the money flow there is telling us something quite strong. So we've got equity markets telling us it's all going to be fine. Bond markets, I think, looking forward to some interest rate cuts and getting a little bit more excited than they were. Commodity markets telling us central banks are not in control under any circumstances. And currency markets aren't convinced either. So all the big asset classes, slightly conflicting signals. They can't all be right. I'm not saying equities are wrong by any means, but they're certainly passing on some different messages from, say, bonds or currencies or commodities. Now, just to pull all of this together, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So Yorkshireman, naturally paid up member of the awkward squad, I always look for the stuff where people are pessimistic and skeptical, because that's probably where the value is. Again, as Templeton said, focus on value, because most investors focus on narrative and outlook. And I've done a lot of narrative and outlook there, but now we're going to start talking about value. And a lot of this grid just comes from the questions I get in my day-to-day job dealing with print, broadcast media. What are they interested in, what are they not? It's a good reflection of what the world is thinking. So we know where the pessimism was, because we talked about it earlier on. We'll look, China and Hong Kong, tricky, but certainly cheap. Precious metals, nobody's still really desperately interested. Small caps, Japanese yen, I can understand why they're a bit down on that. And commercial real estate. We were just talking about that beforehand. For those of you with long memories will remember that UK commercial real estate stocks doubled and trebled after the interest rate cuts of 1992-3, albeit having been through a much deeper downturn than the one we've just been through. It is something perhaps to bear in mind that those stocks trade at big discounts to NAV valuation. Skepticism. I know the UK is at an all-time high, the FTSE 100, but most people still want to give it a good kicking when they talk to me, talk about stocks that are leaving, stocks that are floating somewhere else. It's a lot of junk, it's all oil, it's insurance, it's banks, it's all indigestible rubbish. Might be, but that might be reflected in the valuation, and it is still going up. And the other reason, and I don't want to steal any of Job's presentation, at least unwittingly, but if the UK is going to pay, £80 billion in dividends this year, we've already had £35 billion of buybacks, we've had £60 billion worth of declared bids. Okay, half of that is Anglo-American. But that's 80 plus 60, that's about £175 billion. That's about a 7 to 8% cash yield on the UK equity market. No wonder it's going up. Potentially, looking at that number, it's just pretty cheap. Lots of optimism, I think, possibly in corporate debt, but again, I'll maybe let Reece talk about that. Japanese equities doing well, the US dollar, US treasuries, and NVIDIA's numbers tonight, so I'm not going to set myself as an Aunt Sally. Clearly lots of optimism for very understandable reasons. All I would politely point out to you is NVIDIA's numbers are going to be good, sales are going to treble, profits are going to quintuple, guidance will be strong for the next quarter, I'm sure. But they're going to have to be that good with the $2.2 trillion market cap. Because for $2.2 trillion, I can buy all of Germany's DAX 40, which has got 3 times the annual earnings power of NVIDIA this year, and have $400 billion left in change. Let me know which one you prefer at the end. So where are we? So consensus, consistently wrong. I hope to goodness I'm standing here not being part of it, but that's, again, just the way it works. There are still, on that bell curve, all possible options. The equity market is pricing in Goldilocks, cooling inflation, soft landing or indeed no landing, and rate cuts. You could still get policy error. Central bankers were wrong on inflation on the way up. They could easily be wrong on it on the way down and squeeze too hard or cut too early. They're not priced in. The central scenario is. So if there's any divergence from that central scenario, that's when things get sticky. Debt remains the biggest issue. Central banks, politicians, economies need interest rate cuts to make those big debt piles affordable. Whether that means they have to take their chance with inflation or not remains to be seen, but it's perfectly possible. Commodities and currencies are definitely telling you something different from equities. Bonds, I think, are maybe leaning more towards the rate cut narrative, but I'll defer to Reese because equities are still thinking Goldilocks. So for the last 15 years, we've all been used to low growth, low rates, low inflation mush, which has favoured paper assets like bonds, and it's favoured long duration assets like tech and biotech. But if the world is now a bit different, with higher nominal GDP, with higher interest rates, with a bit higher inflation, maybe what's worked so brilliantly for the last 10 or 15 years might not quite work so brilliantly for the next 10 or 15. And if that's the case, this might be one way of checking. So the CRB Commodities Index, here it is, against the FTSE All-World Index. The CRB Index itself is just at a 10-year high. I'm not a chartist, I'm not a technicals analyst, but if it breaks out, that might be quite interesting. But this looks at the CRB Commodities Index against the FTSE All-World Index, equities. Line up, equities are underperforming commodities. So line up, commodities are doing better than stocks. Line down, stocks are doing better than commodities. So for the last couple of years, on the sly, commodities have actually been doing okay relative to equities, thank you very much, which might be somebody telling you, we're not convinced that central bankers have got it all in control after all. We'll see. Bang on. Thank you very much for your time, everybody. I greatly appreciate it. I hope that was informative, and we'll come back to any questions that you've got. Glad to deal with those at the end.